here today and even more excited to talk about my favorite topic, money. So y'all, I'm not here to sell you anything, ask you to buy anything. So you can go ahead, put your credit cards, your checkbooks, your social security numbers back inside your pocketbook. So we're just here to learn. And I want to teach y'all about a concept, a process that's called the infinite banking concept. Now, some of y'all, maybe you have heard about this before, but maybe it's never been explained to you in this way. And some of y'all, probably this is the first time you're ever hearing about this, and I'm about to challenge and wow some of your conventional thinking when it comes to your money. Because here's the thing, y'all are really great at making the money, but you suck at keeping it. So I just want to show you how to keep the money that you're already making. I don't want you to change anything that you're already doing. I told y'all you're really great at making the money, so I don't want you to work any harder. I don't want you to take on any additional risk or lose control of the dollars. We're just going to change where the money goes first. We'll kind of get into it. Because here's what my late mentor said. He says, Hannah, you want to be in two businesses in your lifetime. The first one is the one that you're passionate about. It gets you up out of bed every single day, supports the family, supports the lifestyle. But the second business is the banking business, the business that finances everything throughout your life. And that's what we're going to be here talking about, is that banking business. So you can see my company, the Money Multiplier, up there on the screen, my cell phone number, my email address, and then also our website, themoneymultiplier.com. So I actually grew up in Kansas City, but now live in Daytona Beach, Florida. So hello to all my Floridians. I'll never change my residency, I'll say. But before we get into it, I want to tell you a little bit about how my family got introduced to this concept. So you see that bald-headed guy right up there on the screen? That's my dad. His name is Brent Kesler, and Dad is actually a chiropractor. And when we were living in the Kansas City area, Dad owned 5 clinics in the Kansas City area. And this was back in 2006. Dad was at a chiropractic convention, and he was sitting in the audience just like how y'all are right now. And there was a gentleman up here on stage teaching about this concept. And Dad was sitting there, he had his arms crossed like this, and he goes, man, that stuff looks really, really good, but it kind of looks just too good to be true. Ever seen something like that, something too good to be true? So what Dad did is he bought Nelson's book, and I'll talk more about Nelson Nash here in a second. But he bought Nelson's book, he went home, he set it on the shelf, and he didn't do anything with the information. 2 years later, 2008, he went back to the same chiropractic convention, and he was greeted by about 10 or 12 of his colleagues who were coming up to him, hooting and hollering about this banking concept. They're like, Brent, isn't this concept so cool? I'm able to pay off my debt, pay the overhead expenses of the office, finance the adjustment tables, and I'm able to recycle and keep all of the money that I sent out. And that's when Dad was like, okay, there's got to be something to this. I mean, no way 10 or 12 of my closest colleagues are lying to me right now. Maybe 1 or 2 of them, but no way 10 or 12. So that's when my family took action, was back in 2008. And back at that time, we had almost $1 million of debt. And actually, Pops has it nailed down to the exact penny. So we had almost $1 million of debt, and by implementing this concept, we were able to pay it off in 39 months. 3 years, 3 months. He didn't work any harder. He didn't open the office for longer hours, treat more patients, increase the rates. He just changed where the money was going first. So now, y'all also need to know who Nelson Nash is. Nelson is not the inventor of this concept. He is just really the guy who brought this concept to the public's eye. So all of the information that I'm going to cover here today comes from this black book, Becoming Your Own Banker. So I highly recommend that you add this to your wealth building library. You can go to our website, themoneymultiplier.com, purchase it from there. I do have a few copies I brought along with me as well, but honestly, I'm not in the book selling business, so you can go to Amazon, get a copy that way too. And if you got a little ADD like myself, it also comes with 2 hours of audio, okay? Now, here's my gift to y'all, just for hanging out and being here today, because I know you guys are taking time away from your families, your businesses. If you send me an email, Hannah spelled the same ways, forwards and backwards, hannah@themoneymultiplier.com, I will send you a copy of our ebook, Mapping Out the Millionaire Mystery. So this is actually a book that my father and Chris Noggle wrote together. You can also scan the QR code, get the book that way. But Chris Noggle, if y'all don't know him, he's very active in the real estate space. Actually had a show on HGTV at one point called Risky Builders. But go and follow Chris Noggle and what he's doing. So my gift to y'all. Now, to be totally clear about what we're going to be here talking about today. So money is what we're going to be here talking about. Now, y'all, in order for us to have this conversation around money, we have to agree on the definition of money. So if I were to ask you, what's the definition of money, what would you tell me? It's a tool. It's okay to say it. All money is just a means of exchange, is it not? That's all money is. All we do with money is we exchange it for the goods, the products, the services that we're buying in life. Money for food, food for money, money for house, house for money, money for car, car for money. That's all money is. So, for the next 6.5 hours that I have your attention here today, that's going to be our definition of money. Can we agree on that? Now, I'm not going to play this video just because of my time I have here today, but here's some homework that I want y'all to do. Go to YouTube and look up the backwards bicycle. Backwards bicycle on YouTube. It's about a 7.5-minute video. I like to play this just because it gets our minds geared into being open and receptive to new ideas and new ideologies. So I'll play a short snippet of it so when you go home tonight and study this stuff in nauseating detail, you know you're on the right video.
Hey, it's me, Destin. Welcome back to Smarter.
All right. Now, y'all, this concept I'm going to share with you, this is not what your parents are doing. It's not what your colleagues, your coworkers, or bosses are doing with their money. We're going to go through some paradigm shifts together. And there's a gentleman by the name of Will Rogers. You know what Will Rogers says? He says the problem in America isn't so much what people don't know, it's what they think they know that just ain't so. So again, a lot of the things that we've been taught about money, dollars, and wealth may not actually be the truth. And I know y'all are going to have questions as I go through this. I want you to write your questions down. Don't just try to keep them up here because you'll forget them. Write your questions down. I'm going to be around all weekend long to answer the questions. I'll give you my cell phone number, my email address after this so we can connect one-on-one. Because my dad has always taught me a short pencil is better than a long memory. So write your questions down because I want to make sure that I answer them. All right. We're going to talk about how does our money flow and the method to get all the money back. Before I get done here today, I'm going to show you how to get all the money back for just the cars that you're buying for yourself in your life. You're probably thinking, Hannah, we're at a real estate conference. Why in the hell are we talking about cars? Well, it's just because everybody gets cars, right? We've all bought in cars, driven cars, ridden in cars. So we just understand cars. But it's not just for cars. Y'all, I'm a lender in real estate. This is what I like to do. I use this concept to double dip on my money. And we'll get into it. So we're going to talk about the mysteries of money. The machine. What's the machine that we're going to be using to build our wealth? We're going to talk about the mission and the marathon. I'm telling you right now, this is not a get-rich-quick kind of deal. This is a marathon. This is a lifestyle change, a process that you're adding to your financial life. We're going to talk about the millionaire and then the movement. All right, let's get into the fun stuff. You see that there's 3 calculators up here on the screen. Let's just make believe that you are in the market and you want to go purchase yourself a car. I don't care what it is, let's just call it a car. And right now at your savings account down at the local bank, let's just say that you have $25,000 that's sitting there. And let's make believe that you found a really, really good bank, and that bank is paying you 4% on your money. All right, I know there may be not, but there's a method to my madness here, okay? Let's just make believe for right now that you found a really, really good bank, and that bank is paying you 4%. So you walk into the bank, and let's make believe I'm your bank teller. You come up to me, and you're like, Banker Hannah, I want to take out that $25,000 that's earning me 4%, and I want to go pay cash for that car. And y'all tend to bump up your chest like that. I'm going to go pay cash for that car. Y'all love paying cash for things. You think when you pay cash for stuff, you don't got to pay any payments and you don't got to pay any interest. But is that the truth? Ponder on it. We'll come back to it. So you walk in and you're like, Banker Hannah, I want to take out that $25,000 that's earning me 4% interest, and I want to go pay cash for this car. And I turn to you and I say, no, no, no. Instead, how about I make you a loan for $25,000? I'll loan you $25,000, and I'm going to charge you 6% interest. All right. If I were to go and take a loan for $25,000, how long is it normally going to take me to pay off the loan? 4 years, 5 years, 6 years? I don't care. Let's just call it 5 years or 60 months. Instead, how about I issue you this loan of $25,000? I'm going to charge you 6% interest. And over the same equal time period of 5 years or 60 months, our bank will pay you more money on the 25 that you're earning at 4 than you'll pay us on the 25 that you're borrowing at 6. Is that a true statement? In other words, can I make money earning 4% at the same time I'm paying 6? Well, no. My simple mind is thinking, well, hey, if I earn 4, pay 6, I'm losing some. 4 minus 6 equals -2. As us Gen Zers say, that math ain't mathin'. But the banker told you the truth, and I want to walk through it. If you took out that loan of $25,000 at 6% interest, your monthly payment would be $483.32 a month. Take the $483.32 times the 60 months, you just paid $28,999 for the car. So $25,000 in principal, about $4,000 in interest. Over the same time period in your savings account over the 60 months, your balance is now $30,525. So here's my question. Is the $30,525, is that a larger number than the $28,999? Or do y'all do math differently than what I do down in Florida? I mean, it's a larger number. But why? I thought if I earn 4, pay 6, I'm losing some. You got any ideas? Compound interest, I hear. Here's what's going on. In your savings account, that is on an increasing scale. It's going up each and every month, where your payments are going down every single month. So one's going up, the other one's going down, but our minds are not programmed to think this way. With this short, simple exercise, I just wanted to prove to you that you can make money all day long earning at a lower interest rate than what you're borrowing. And y'all, go run the math. It's just math. I have a podcast show that I do every week called the Money Multiplier Podcast. I did a live example of earning 10% at the same time I'm paying 20%, and I still come out on top earning 10 at the same time I'm paying 20. We got to start learning how money actually works. So why is my 4 and 6% important? I told you it was a method to my madness here. Let's talk about the machine. The machine that we're going to be using to build our wealth. Y'all ready? A whole life insurance policy with a mutually owned company that pays dividends. I wish y'all could be standing up here right now and you could see all your faces. Because I get it. Before you run out of the room and you vomit on me, you're thinking to yourself, Hannah, I know everything there is to know about whole life insurance. Dave Ramsey and Susie Orman, they told me whole life insurance is the worst place to invest my money. I get it. My dad was a Dave Ramsey's baby step follower. Do you get why it took him 2 years to start this stuff? But here's my question, why whole life? Why whole life? Y'all got any ideas? When I normally ask that, I get a lot of good feedback from the audience. But here's the number one reason. This is what the elite and the wealthy are doing. The number one purchasers of whole life insurance in the world are conventional banks. Banks actually own more in whole life insurance than all of their land and their buildings combined. And a matter of fact, since 2013, banks have even quadrupled in their portfolio of how much whole life insurance they own. Are banks stupid, or are banks doing something the rest of us just don't know about? They're probably doing something. And don't just take my flapping gums for it as the truth. Go and Google something called BOLI, B-O-L-I. It stands for Bank-Owned Life Insurance. And you can look up the hundreds of pages that come up of how much whole life insurance these banks actually own. But I want to be specifically clear here, because this is not just the regular whole life insurance that you can go buy off the shelf from your brother-in-law that sells life insurance. We all got a brother-in-law that sells life insurance, do we not? It's got to be designed specifically for this infinite banking concept. So what I mean by that is when I put $1 into this policy, immediately, my definition of immediately is within 30 days, I have access to cash value that I can take out that cash value and go deploy it or use it somewhere else. So it's got to be designed specifically for this infinite banking concept. Now I want to go back, because why was my 4 and 6% important? Inside of your policy contract, you get a guaranteed interest rate. Guaranteed interest rate. And again, that's not my flabbergum saying that, that's written inside the policy contract. And the interest rate that the insurance company will charge you to take out that loan, 6%. So can I make money earning 4 at the same time I'm paying 6? Yes. Let's move on. So now we know what the machine is. I'm going to be skipping over some stuff today, just because of my time that I have here. I normally have about 90 minutes worth of material, but I don't got that time today, so I'll show you how you can go back and rewatch all of this stuff that I skip over. But I want to talk about one of my favorite topics. How do banks work? Because this is how your bank works. Doesn't matter where you're at in the world. You could be in my town of Daytona Beach, Florida. We could be right here in St. Louis, where I was actually born at. Or it could be in Austin, Texas. I don't care. This is how your bank works. You deposit money into the bank. Let's just say that it's $100,000. I don't care what it is. The main point I want you to get is that this is your money. You deposit money into the bank, and we're going to make believe that, again, you found a really good bank, and that bank is going to pay you 4% on your money. So if I make my deposit into that bank, that deposit is now a liability to the bank. Why? Because they got to pay me interest on it. So how does the bank turn around and turn that liability into an asset? They loan it, right? They loan it back out to you or to other people to go buy the things in life. Who besides myself has ever gone down to the bank, asked to borrow money to purchase a house? Let's call that 7%. Bank issues you the loan, you go purchase the house, you open up that mortgage note, and then what do you got to do? You got to pay the bank back. You got to pay them back on time, because if you don't, they're going to come and foreclose on you. So money goes back into the bank. Who besides myself has ever gone down to the bank, asked to borrow money to purchase a car? Let's call that 8%. Bank issues you the loan, you go buy that sexy new automobile, and then what do you got to do? You got to pay them back. You got to pay them back with interest on time, because if you don't, you're going to hear that beep, beep, beep as the tow truck is coming and towing it off your driveway. Money goes back into the bank. How about a home remodel? Maybe new granite countertops, a swimming pool in the backyard. Let's call that 9%. Bank issues you the loan, you go pay off all the contractors, money goes back into the bank. I hope y'all can see what's going on here. All banks do is they move money in, they move it out. They move it in, they move it out, they move it right back in again. Lastly, let's do a debt consolidation. Go pay off all the credit cards, let's call it 12%. Well, money goes back into the bank. All right, I know math is not everybody's favorite subject, but we're gonna do a little bit of math, but I promise I'm gonna keep it very fun and very easy. Because here's what I wanna know. I wanna know how well I did compared to how well the bank did. Because remember, I found a really good bank paying me 4%. So, in the first transaction of the house, bank made 7, we made 4. 7 minus 4 equals 3. Told y'all it was gonna be easy. How about in the car transaction? Bank made 8, we made 4. 8 minus 4 equals 4. In the home remodel, bank made 9, we made 4. 9 minus 4 equals 5. In the debt consolidation, bank made 12, we made 4. 12 minus 4 equals 8. That one's usually the hardest one. If you add all of those up, bank made 20%, we made 4%. How much better did the bank do than us? 16%, Hannah, right? Isn't 16%? How about 500% more than what you did? Because doesn't 4 go into 25 times? Y'all, banks are making no less than 400 to 1,300% annually on the money that you leave there with them. And again, fact check me on this stuff. Go look up BauerFinancial.com, B-A-U-E-R, BauerFinancial.com. You can look up the big banks that we all know the names of, your small hometown banks, and go look at their annual report. And I challenge y'all to do this. Find me a bank that makes less than 400% annually on the money that you leave there. My father and I, we've been traveling around teaching this stuff since 2012, and I ask every single audience this question. Nobody has ever found me a bank that makes less than 400%. And I seriously challenge y'all to go and look one up. But it kind of makes sense, though, if you think about it, right? Because what risk are the banks taking in doing all of this? Not a lot, because whose money are they using? They're using your money to do it. Now, I do agree the interest rate offsets the risk, but if you're too risky of a borrower anyways, is that bank even going to issue you the loan? No. Here's all that I'm saying, y'all. You guys are doing this in your lives anyways. You're buying houses, you're buying cars, you're doing home remodels, and you're using credit cards. So why don't you just be the banker in your own life and you make that 500% on your money instead of the bankers making a good living off of you? I get it. We've just never been taught a different way. Because when I go make my money, because I got to make money to live on this God-given earth we call America, what do? We go leave it at the bank because that's just where they keep the money at. Now, if you really think about it, though, again, I don't care where we're at in the world. We could be right here in St. Louis. When you come into town, there's a main intersection within the town. And there's 4 corners on that intersection. Name me one of the buildings on those 4 corners. No, it's not Starbucks. It's a bank. And are banks on the bad landscaping, bad architecture, rundown property? Nah, man, they're like the nicest buildings in town. And a matter of fact, when you walk into some banks, don't they kind of give you stuff? Like those dumb suckers that are sitting there on the counter? Oh, that's a little ironic, is it not? Matter of fact, there's a bank in our town in Daytona. If you go in there on a certain day of the week, they actually give you wine. They give you wine if you go in there. So that's why you get me today instead of my father, because he went to the bank 7 times yesterday and he's in bed hungover. I'm just kidding, don't tell him I said that. But y'all, does that make sense? All I'm saying is that you be the banker in your own life. So go look that up too, BauerFinancial.com, B-A-U-E-R. I want to move on, because I want to get into more of the fun stuff. I want to show you how to get all the money back for the cars that you're buying and driving for yourself. Because I don't care how old you are today, how much money do you have back for just the cars that you've bought for yourself up to this point in your lifetime? Here's a hint, 0. So if I do nothing more than just show you how to get all the money back, is it going to be a pretty cool day? I think so. So everything else that I'm going to cover here, y'all should all have a handout. If you don't have a handout, raise your hand, and Larry and Wesley will come through and give you one. So everything else, you can look down here within your handout. I would recommend just looking up here just because of the transitions that I'm going to go through. But if you have trouble seeing, you got it right in front of you as well. So let's just do a quick recap. What is the machine that we're using? The machine that we're using, a whole life insurance policy with a mutually owned company that pays dividends. Now, in this policy, there's premiums. Here's where the paradigm shift starts to happen. Premiums are our deposits. Because if I put money into an account that I own and I control, and I have access to the cash immediately, what's my definition of immediately? Within 30 days. Is that treated more as a payment or a deposit? I say deposit. What word y'all like better, payment or deposit? So there's premium deposits that go into this policy. Now there's age and death benefit on the policy. I'm gonna blow it up. Age and death benefit. You'll notice that they're grayed out. Why are they grayed out? Because they do not matter. Oof. I just hit a chord with some of my analyticals in the room, and if I don't explain age and death benefit, you're not gonna get anything else that I say moving forward. So let's talk about age and death benefit, and we'll talk through it quickly. Let's make believe that I have 3 individuals, age 20, 40, and 60, all in the same equal health. They have a $20 bill in their pocket. Age 20, 40, and 60, same equal health. They walk into the grocery store. Who between them is going to be able to buy the most amount of groceries with their $20? All of them, right? Doesn't matter how good you look, how bad you smell, color of your skin, the language that you speak. I mean, the same $20 is going to buy you the same amount of groceries. Now let's walk across the street to the life insurance store. Age 20, 40, and 60, same equal health. Who's going to be able to buy the most amount of death benefit with their $20? The youngest one, right? That just makes sense. But I'm not here talking to y'all about death benefits. I'm here talking to you about the cash and the cash value that you can use within this policy. And I really want to drive that one home because I'm going to get done here today and someone's going to come up to me and say, Hannah, that was some really cool information, but I'm too old to do this. No, you're not. Just because you're older means you're going to have a lower death benefit compared to someone like me who's 25 years old. But if we put the same amount of premium into our policies, our cash is going to be the same. Does that make sense? That's why it's got to be designed specifically for this infinite banking concept. All right, let's move on. Starting on the left-hand side, all that is just time. Year 1 to 8, year 9 to 13. Then you have your premium deposits. In this example, this gentleman says, okay, I know that I'm worth $10,000 a year. That's a number that he chose. If 10,000 is too large of a number, shave off a 0, do 1,000. If 10,000 is too easy, add a 0, do 100,000. I don't care, you get to decide how much you want to deposit into your policy. When I was 18 and I started my first policy, I was still a waitress at Cracker Barrel. You think I could afford 10,000 to a stupid life insurance policy? No. So I started off $400 a month. I was saving $100 a week. That equates to $400 a month. And Dad says, okay, that's where you're going to start your first policy at. I said, yes, sir. So in this example, he's paying his premiums, he's doing $10,000 a year, and he's paying them for the next 7 years. Now, in year 4, we're in the market, we want to go purchase ourselves a car. Another thing, I would never have you wait 4 years to start using the cash that's available in your policy. Because how soon do you have cash available? Immediately. Good. But I'm just doing this to isolate the car purchase here, just for learning purposes. So in year 4, we're in the market, we want to go purchase ourselves a car. Let's call it a $25,000 car. Where do we pull the $25,000 from? The cash value that's inside of that policy. So I take out the $25,000, I walk down to the car dealership, I hand over the money, they hand me the car, and then everybody walks away. The transaction's done. And that's where most people stop. But because you borrowed from yourself, don't you think it's a good idea that you should pay yourself back and charge yourself interest? Yes, Hannah, that's a really good idea. But do you ever do it? No. Here's another big one. Treat your money just how you treat the banker's money. Because if you don't, all you're saying is your money is not as valuable as the banker's money. And that's not the truth. So we're going to play honest banker with ourselves. I'm going to pay myself back and pay myself back with interest. I'm going to pay myself back $500 a month or $6,000 a year over the next 5 years. So I put back 30, 25 for the car purchase, paid an extra $5,000 of interest to myself. Let's see what happened from year 1 to year 8. He put in $70,000 as his premium deposits, plus he put back 30, so a total of 100 has gone into the policy up to this point. But he did take out 25 to go purchase the car. So 100 went in, I've taken out 25. 100 minus 25 is 75,000. 75,000 is my true net injection, and I'm sitting here in year 8 with 73,226 as cash value that's in the policy. If you take that 73 and divide it into 75, you just got back 97 cents for every dollar that you spent on that car. Wait, Hannah, hold on. I'm not getting it. How is the money still growing even though I've taken it out and I'm using it? Here's your next big aha moment, so time to wake up again. When you are taking money out of the policy, you are not withdrawing that money. You are taking out a policy loan. So what you're doing is you're putting your death benefit up for collateral, and you're taking a loan from the general funds of the insurance company. You're using their money in the real world, and that's how and why your money continues to grow as if it wasn't even touched. Is that cool or cool? I don't know of any other vehicle on the planet that does this stuff. Do y'all remember how I asked you earlier that you guys love paying cash for things? Because you think you don't have to pay any payments, you don't got to pay any interest? Here's what you're doing. And for my analyticals, if y'all really want to nerd out on this, it's called the opportunity cost of your money. But let's say that I have a $25,000 bill sitting inside of my checking account or savings account, and I just go and withdraw it to go pay cash for the car. Cool, I've accomplished the goal of buying the car, but that $25,000 is gone. It's left my hands, it's left my family forever, and in order to get that $25,000 back inside of my pocket, earning me interest again, I gotta go work for it, I gotta go earn it somehow. So that's why we're just adding the one additional step of running the money through the policy first, and then I'm gonna go take it out to go do XYZ with it. Because you can use the cash in the policy for literally anything. Go buy a pack of chewing gum down at the convenience store if you really wanted to. Does that make sense? Let's continue on though, because that car is gonna wear out on us. Let's say that in the 9th year, I'm in the market and I want to go purchase myself another $25,000 car. So where do I pull the $25,000 from? The cash value that's in the policy. Now, at this point, you're no longer making any premiums into the policy. But in real life, if you really get this stuff, you will quickly understand that you want to pay those premiums as long as you can and as much as you can. We can talk about that a little bit later. So in this example, no more premiums are going into the policy. I want to go purchase myself another $25,000 car. I take out the money, go to the car dealership, hand over the money, they give me the car, and then everybody walks away. I'm going to repeat the same process, play honest banker, pay myself back, charge myself interest. So I'm going to do the same thing, pay myself back $500 a month or $6,000 a year over the next 5 years. So let's see what happened from year 9 to year 13. I put back $30,000 for the car purchase, but I took out $25,000. So 30 went in, taking out 25. 30 minus 25 is $5,000. So my true net injection is $5,000, but my cash just grew from 73 to 95. With a $5,000 net injection, your cash just grew over $22,000. How do you like buying cars my way? Is there anything stupid, ridiculous, or idiotic here that I'm doing? No, man. I just bought a stupid-ass life insurance policy, and I'm using it to buy my cars. Y'all were going to go buy the cars anyways, were you not? Ooh, Hannah, that wasn't nice. Why'd you use the word ass? Well, some of you are texting, a few of y'all are sleeping, but since I said that word ass, y'all are right back up here to my screen. So hi, welcome back to class. Because here's another big aha moment. I want to see what happened over these 13 years. Because 13 years goes by pretty darn quick, does it not? 13 years ago, I was 12 years old. Oof. So let's just see what happened. You put in $70,000 as your premium deposits, plus you put back $30,000 for the first car purchase and another $30,000 for the second car purchase. So a total of $130,000 has gone into the policy up to this point, but you've taken out $25,000 for car 1 and $25,000 for car 2. So $130,000 went in, and I've taken out $50,000. $130,000 minus $50,000 is $80,000. So my true net injection is $80,000, but I'm sitting here in the 13th year with 95 and some change as cash value in the policy. How much did it really cost me to buy, drive, and own these cars? I mean, my simple mind is thinking, well, hey, it didn't really cost me anything, kind of made a little bit of money by doing this. But I can't sit here and tell you that costs you nothing. Because you had to start this system. You had to start the policy. Year 1, if you notice, when he puts in that $10,000, he does not have access to that full $10,000 quite yet. But are you in this for the short term or the long term? You tend to tell me long term, but you get hung up in short term thinking. Have y'all ever read a book by Rick Warren? It's called A Purpose-Driven Life. In that book, Rick Warren talks about how life is like a marathon. It doesn't matter how you start, it only matters how you finish. This is the game of life. And y'all, I'm not gonna reinvent this wheel. I'm just mimicking and imitating what these elite and the wealthy people are doing. If you go look up the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, they all understood money, and they understood how to keep the money within the family. Because here's what Albert Einstein said. You know Albert Einstein? He says compound interest is the 8th wonder of the world. Those who understand it earn it, and those who don't pay it. What do you think we've been doing all these years being consumers to the banks and other financial institutions? We've been paying that compound interest. Again, now we know the game. I'm just going to play the game right along there with them. And y'all, this stuff is not on trial. It's not being tested. Whole life insurance has been around longer than our tax code's even been here. Who knows when our tax code came about? 1913. There's so many features within this vehicle that you can't do with any other vehicle on the planet. And please tell me, y'all, if you know something that's better than this, please tell me. My family's been looking since 2008. We haven't found anything else. I'm always open to learning. But there's rules to this that you got to follow. Rule number 1, pay yourself first. I know you guys have heard that before, but do you really do it? No. If you get nothing else from my talk today, seriously, start paying yourself first. Here's how you do it. When you get money that comes in, take a sliver of it. At least 15% is what I say. Take a sliver of it, set it to the side, pay yourself first, and then go pay everybody else next. So in my opinion, the pay yourself first, that's the dollars that should be starting to flow through the policy. Rule number 1, pay yourself first. Rule number 2, pay yourself back and charge yourself interest. Play honest banker with yourself. Rule number 3, recycle and recapture the dollars. Y'all, if this works for a car, what else do you think it works for? Let's say instead of that being 10,000 premium deposits, what if it's $1,000 premium deposits, and that's a $2,500 MacBook computer? And then I just pay myself back $600 a year. Does the concept still work the same? Yeah, it's just smaller numbers. What if instead that's 10,000, what if it's $100,000 premium deposits, and that's a $250,000 house? And you just pay yourself back $5,000 a month, $60,000 a year. Does the concept still work the same? Yes, it's just bigger numbers. Who's my lenders in the audience? Any lenders? I'll tell you, it's one of my favorite things to do. Let's say Dustin calls me up and he's like, Hannah, I need $25,000 because I'm going to go do this rehab on this house. Will you loan me the $25,000? Yeah, Dustin, I'll loan you the $25,000. I hold first position, nothing less, because if you're not first or last, I'll loan you the $25,000. Who do you think is now paying me back the $500 a month or $6,000 a year? Dustin's paying me back that money. Ooh, that just got interesting. Y'all, I don't care what it is, you are turning every liability into an asset, every depreciating asset into an appreciating asset simply by running it through your own banking system first. So if it works for a car, what else does it work for? A bicycle, a pack of chewing gum, an airline ticket? Y'all, I travel around the country in my van. Yes, I'm a little hippie. I live that van life. And I travel around with my cat. I bought myself a $200,000 conversion van. This is the same thing that I'm doing just with that van. I do it for my houses, my properties, anything and everything that I'm buying, I funnel it through my own banking system first. Because now I'm the one capitalizing on myself instead of the bankers making a good living off of me. And it makes sense when I put it this way, but it's never been explained to you this way, right? Y'all know a man by the name of Robert Kiyosaki? He's famous for the book Rich Dad, Poor Dad, but he also wrote a second book called Second Chance. In that book, Second Chance, Robert Kiyosaki talks about this concept. But y'all read right through and didn't think a second thing of it. Again, it's never been explained to you this way. Or how about Tony Robbins, Money Master the Game? Chapter 5.4 in that book, Tony Robbins talks about this. But again, it's just never been laid out like this. Here's another resource too, Larry Steinhaus. He's a gentleman up in Langhorne, Pennsylvania, right outside of Philadelphia. I would go and research, see some of the stuff that Larry's putting on. But in this book, Money Hacks, chapter 13, Larry talks about this. But the main reason of why I have this book up here is the subtitle, because it says, because everything that you think you know about money is wrong. Because what do your people tell you to do? Hey, go get a degree. Go work that good job. Max out those 401ks. And then later on, let the government take care of you. How well has that been working out for people up to this point in our lives? Seriously. I dropped out of college because I thought it was more fun making money than what it was sitting in class going to school all day. So, those are other books I want you to add to your wealth building library. But to bring it full circle, this infinite banking concept, it's not a product. It's the process of taking back the control of the banking function within your life. Because y'all, if I could do the same thing with these plastic water bottles, I'd be hooting and hollering to you about how cool plastic water bottles are to grow and keep the money within the family. But it's not, it's just a whole life insurance policy. So when you make any purchase in your life, you either pay out the interest to somebody else, AKA bank financing it, or you lose the interest that you could have earned on that money, AKA paying cash. Now that I know this, I'm not losing out on that interest on my money for the rest of my life simply by running it through the policy first. Does that make sense? Now, I'm not going to get into this right now, but this is the and asset. It's not the either or. It's not like I'm saying, hey, go put your money into real estate or put it in the policy. No, it's the and. I'm going to run the money through the policy first, and then I'll go make that real estate purchase. So, I'm going to skip over this as well. Those are some of the tools. Actually, I get this a lot. Sometimes I'm up here on stage, and people will come up to me, and they'll say, Hannah, that was some really cool information. Who do I go to get one of these policies? I'm like, me, pick me. Because I know sometimes I kind of get lost in the education. I don't really tell y'all where to go. But that's what my company, the Money Multiplier, does, is that we help our folks obtain the policy, design it properly for your needs, your goals. And then once you have that policy, how do I start using this thing? So actually today, y'all get a special treat because I brought Larry and Wesley out with me. They are a part of our implementation team. So when folks start a policy, that's when our work really begins. Because now, how do I use it? How do I take out the loans? What should I be using this money for? Do I go pay off some debt? Should I invest this money? What are we doing right now? And so that's why it's important to work with somebody that understands this and is going to be there for the life of the policy, not just a yearly check-in. We check in every single quarter. And that's a free service that we do for the life of the policy. Because it's important. Banking is a process. It's not just a product. It's ever-changing. Our financial life, we have upswings and we have downswings. We have those windfalls and we have those downfalls. And life happens. We're going to have to go through it. So, Hannah, you're just a young girl flapping your gums up here. How do I know this stuff is really true? Or how come I've never heard about this before? I'm going to show you this article. It's dated November 16, 2016. And I remember this day because actually Dad was about to get up on stage in Denver, Colorado to teach on this. And in November time, it's a good time to check the sports scores, so he's on ESPN. And this article pops up. Cash value life insurance makes Harbaugh College football's top paid coach. The University of Michigan is doing this stuff. Or how about Disneyland? Walt Disney wanted to start Disneyland, but after failing in the pursuits of traditional means of financing, meaning that Walt walked into the bank and he says, guys, I got this great idea. It's called Mickey Mouse and Donald Duck. Will you give me a loan? The bankers laughed at him. They said, nah, man, we're not going to give you that loan. So what he had to do is he had to collaterally borrow money from his cash value life insurance policies. Who knows if Walt never even had those policies, if Disneyland would even be here today? Or how about Ray Kroc with McDonald's? Kroc partnered with McDonald's brothers in 1955. He did not take salary for the first 8 years, and to help with cash flow, he borrowed from his 2 cash value life insurance policies. And he used that money to cover for the salaries of the key employees. And he also used some of the money to finance for the advertising campaign that we know of as Ronald McDonald. Speaking of, have you guys seen Ronald around recently? I don't know what he's been up to. I haven't seen him in a long time. So if you see him, tell him I said hi. There's so many other stories. The Pampered Chef. Actually, I'm going to tell you all this one. This one's very impressive, one of my favorite ones. Using $3,000 she borrowed from her life insurance policy, Doris Christopher started the Pampered Chef in her suburban Chicago home. By 2002, the company had grown into a $700 million operation. that then was acquired by Warren Buffett for $1.5 billion, billion with a B. And it just started out by borrowing money from the policy. Y'all, there's so many other stories. Stetson University, J.C. Penney, Foster Farms, so many other stories on this whole concept. Now, everything I've said up to this point has been fact. Now, here's just my opinion. Now that you know this, everybody should be doing it. Because if you don't, you're stealing from yourself, your children, your grandchildren, and future generations to come, because you're letting the money leave the family. I don't know when Warren Buffett said this, but I remember when my dad started to bring it around the kitchen table. Warren Buffett says if poor people would just start doing what rich people do, they wouldn't be poor anymore. How much freaking sense does that make, y'all? Now, there's only going to be one or two things that's going to happen to us. We're either going to live or we're going to die. I like to use the word graduate, but y'all can use whatever word you want to use. But if we live, are we better off with or without this? Hopefully I showed you with. If we die, pass, or graduate, are our beneficiaries better off with or without this? Because y'all, there's a death benefit on the policy. But how much did I even talk about that death benefit today? Not a lot. It's going to be on the policy whether you like it or not. It's just the cherry on top of the cake. Actually, let me go on a quick little tangent. Y'all, you guys spend so much money on if insurance, the flood insurance, the fire insurance. Y'all will spend buku bucks on those if insurances, but you neglect the insurance that's actually guaranteed to happen. Why do you do that? Just want y'all to think. So there's death benefit on that policy because it's not an if it happens, it's a when it happens. My family's going to receive that lump sum tax-free check. Policies are exempt from judgments and liens in most states. In most states, if you get sued, and I'll tell you something, the higher up your ass is on that flagpole, the bigger the target it becomes. If you ever get sued, have a judgment or lawsuit, a lien against you, no one can come after the money inside of your policies. You know what they can come after? Your bank accounts. Y'all remember a guy by the name of O.J. Simpson? O.J. Simpson, he was found not guilty in the criminal trial for killing the Goldman boy, but he was found guilty in the civil trial against the family. Did the family get any of O.J.'s money? No. Where was O.J.'s money? Inside of his policies. And y'all, I don't know if you saw that, but O.J. actually passed in April of last year. And I've been kind of following that story closely because I just want to know, like, what's going to happen to his estate now, you know? So follow my podcast show, we'll get into it. How about the internal values of the policy grow tax-free? Y'all, because here's what you want to do. You want to pay tax on the money one time only at the lowest rate possible, and then get that money to a tax-free environment where now it's growing tax-free. Totally opposite to what your financial advisors are saying. It actually pisses me off a little bit. You know what they tell you? They say, hey, take the tax deferments now because later in life, you won't be making as much money, so it's okay. Totally backwards thinking, y'all. So I want to pay the tax one time only, lowest rate possible, and then get the money into a tax-free environment where now it's growing tax-free. So all that growth in the policy, tax-free to you. How about loans never have to get paid back? Loan on your policy doesn't have to get paid back. I think it's good practice that you should play honest banker, but do you have to pay them back? No, because you know what a loan on the policy is? It's nothing more than a prepayment of your death benefit. So when you call into the insurance company, you'll notice that they never ask you what you're using the money for, when you're going to pay it back, or how you're going to pay it back. Because honestly, they just don't care. They know you have a guaranteed expiration date, and at that time of your passing, any outstanding loans will just get subtracted from your death benefit. So that's why the loans never have to get paid back. Now, this isn't the only reason we're doing this, but maybe one of the reasons why.
I wanna be billionaire, so freaking bad. Buy all of the things I
So, I am done. Hopefully I taught y'all something new and we learned together. Now, reminder, send me an email. I'll send you a copy of our ebook, Mapping Out the Millionaire Mystery. You can also scan the QR code. Now, if this is just something that you want to talk about, you have questions about, I will be at the booth as well. But on the last page of your handout, there's a contact sheet, name, phone number, and email. Now, I have rules to this. If you turn in your contact sheet and you want to have a one-on-one conversation to get your questions answered, number one is make it legible, okay? All of y'all aren't a bunch of doctors, okay? Make it legible. Number two, if you do turn in the sheet, actually answer when I call you. Don't just turn in the sheet to be nice to me. I have plenty of friends, okay? But if you do turn in the sheet, don't make me go through your gatekeepers to try and find you, all right? So name, phone number, and email, and then hand it into Larry and Wesley. Larry, Wesley, raise your hands. Woo, 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 woo. Okay? So I know I skipped over some stuff today too. So you got the QR code on the bottom. Is that left? Left-hand corner? Right-hand corner? So on the bottom right-hand corner, that will take you through the whole entire recorded presentation. You'll actually meet my father there. You got my cell phone number on the screen, my calendar, my email address. So I am done. You got your handouts and your sheets. Thank you, y'all. Thanks for the time. Hey y'all, thanks for tuning in. If you enjoyed this content, click right here and it will take you to last week's podcast episode. I will see all of you beautiful money multipliers next week. See you then.